Hello everyone, back again. Wanted to show you exactly how to use a stock calculator and various valuation methodology to come up with a better estimation of a stock's intrinsic value, um, to make better investment decisions as you think about building a portfolio of dividend stocks or investing stocks. But um, our stock calculator itself is pretty just straightforward, but in order to get to your stock calculator, you should value the underlying stock and what you think a true valuation is, of the stock price in advance of sort of plugging in any sort of commissions or true costs that would affect your total return. Right now, I'm on a DCF model template that's provided by Finbox Premium. This is a service, if you've seen some of my other videos, I'm a huge fan of it. There's other tools out there that allow you to download templates. This, for the affordability and the powerful nature of the templates, as well as the dashboard and all the various research components of Finbox. Um, you know, that's a tool that I love. And so I'm on Premium, which is $39 a month. That's very, very cheap relative to tools that are out there like S&P Capital IQ that costs firms $20,000 to $30,000 per user just for a year. Here you can get it for $39, and actually they have an offer right now going on that it's if you want to just give it a shot, it's $1 to try it for 30 days, and then you can cancel basically at any point in time. Finbox.io, in my opinion, is the best, most affordable tool for any sort of retail investor to make better decisions, build better portfolios. So anyways, let's run through a case study of valuing a stock. Right now I have Apple's stock completely input in a 5-year DCF, assuming an EBITDA exit rather than a sort of perpetuity growth assumption at the end of 5 years. I like that because we have some sort of metrics in comparable companies on an EBITDA exit. That basically assumes that it's a stub value off of a multiple of earnings that go into perpetuity rather than the growth method is a little bit more intuitive in terms of growth rate assumptions to hold the stock. If we have comparable companies, we might as well use similar trading multiples for an exit. So here's a DCF. I won't go exactly into what a DCF is. You should sort of know this by now, but it's basically sort of a way to look at free cash flow of a business over uh, defined period in time, 5 years in this instance, discounted back at the average cost of capital, um, where you get to an enterprise value. From there, you walk down, make adjustments based on cash, debt, short-term investments, any other potential liabilities, um, uh, to arrive at a equity value, and then build down to on a per share value basis. But it's it's the most reliable method in terms of valuing a company because you're building projections that correspond to the business, as well as working capital expenditure needs as well to build down to a free cash flow. That free cash flow is king, and so whatever a company is generating in cash flow is really what drives most of the value, of course. Um, so, anyways, here we have a build down of all the various CapEx needs, and these are all built off of general assumptions that come from Finbox and their projections build. And so as it relates to sort of fair value, we have a selected discount rate of the true WACC of the business. Um, and an exit of the average comparable companies, which is down here in row 304. So now you have a benchmark of various comparable companies. Apple's, as you know, is a whole different beast to a number of these different businesses. One is obviously Microsoft, that's somewhat comparable. Right now, Apple's trading at about 8 times EBITDA. You know, Microsoft is at 16 times, and a business that has grown at 16% on top line relative to 17, and has obviously favorable 31% EBITDA margin. So using just the general assumption for DCF value, using Finbox's assumptions, we arrive at a $220.84 per share value for Apple. The other method that we'd want to look at is the comparable company method. Similar to our comp set that we have in our DCF, we use financial ratio analysis, growth rates, size, and actual financial performance metrics to derive at a fair value multiple for the business of Apple. And so going through the model here, I've input the powerful thing about Finbox is, of course, the nature of just being able to input any ticker, and it'll automatically populate your entire comp set, all your metrics, and I'll do a full build in terms of fair value for you. So let's go back to Apple. So Apple's grown EBITDA over 5-year CAGR at 8%. Latest 12 months is 14.4%. I mean, that's extremely attractive for a business that's trading at only 8 times EBITDA. Here we have selected low, mid, and high points of selected sort of multiples, and then the full build from EV down to equity value. This implies, based on a mid to high, is 189. I would say, yeah, if you average them all between the two, yeah, since this is just a 2 times EBITDA spread, it's basically the average of these two. And so you get to a value of 189.08 if you select sort of a true value of 9.4 times. This is all based off of an average of selected trading multiples. For me, I would say that the forward multiple is 9 times. That obviously assumes that EBITDA would mean that is declining. The problem with Apple is that it doesn't, valuation-wise, they never get credit for future growth. Everyone is sort of presumes that they've grown to be so large at this point in time that they can't grow much more beyond what they already are without any new product that they come out with is going to cannibalize other products. But they continue to prove people wrong and continue to grow the business, and valuation really never sort of keeps up with the pace that they're at. I think a 10 times is probably reasonable in terms of forward EBITDA. You know, Even though they potentially could be not growing as fast as they used to, they are also extremely large. They can price out competitors. They have a pricing advantage with their suppliers. They have dominant market share with their products. So to me, I don't think Apple is going out of business anytime soon. So Yeah, so I think, I mean, at 10 times, and you have companies like Microsoft trading at 16 times EBITDA. Um, it's not unreasonable to assume that 10 times would represent a decent value for Apple. So that would imply sort of a 188.97 price relative to a market price of about 173 at the current moment. So they've grown at 8 times 5 year. Next year, the EBITDA is supposed to decline by 6.6%, but then increase at 4%. But 5 year forward CAGR is 1.6%. So this is probably a good transition into the third methodology. And if you are a dividend investor, check out my dividend discount model calculator. You can find that at millionairemob.com/ short form dividend discount model. I've input all the information related to Apple. So expected annual growth rate of 8%. Their yield right now, if this is right around 173, is 1.7% dividend yield. Okay. They pay out their EPS. EPS may not be in here. Just for ease, let's go to Yahoo Finance. In terms of free cash flow, even though EBITDA is supposed to decline, you see sort of a similar trajectory in terms of free cash flow. So let's do a quick CAGR on the free cash flow. – 4.5%. Maybe 12 in terms of EPS. So payout ratio of 24%. So that imply, so if they're supposed to grow at 4.5% in terms of free cash flow over the next 5 years on a compounding annual based growth rate basis, I think there's sufficient room for them to at least grow at 8.75% on the dividend. That might be probably the high end on a midpoint basis, probably 8.25. Because even though they're growing at 4.5%, their payout ratio is low enough that I think they'll be able to grow it at least 8.25 for the foreseeable future. if not more than that, because at the end of the day, they're still growing free cash flow. And so, um, yeah, it's not great that they're going to be increasing their dividend more than what they are in terms of EPS or even free cash flow. Um, but the good thing is that that there's probably ample room for them to reinvigorate growth either through reinvesting some of that free cash flow. Um, they could be doing share buybacks, releasing a new product line, increasing price on the iPhone, which they've already done, and that is reflected in their 14% earnings growth or EBITDA growth for the most recent period. So that would imply 182.08. So dividend discount model, DCF comps. Let's just pull in this. If you average them all just on a straight average, you get to about 197. For me, I think we probably want to do some sort of weighting. I would do 50, 30, 20, or even probably 40, 40, 20. Oops. So 200 if you weighted this all out on a weighted average basis. So right now, if you bought 10 shares of Apple at $173, back in the day, you'd have to pay commissions based off your total transaction. I mean, people probably do that now on the institutional level, but retail investors probably don't uh, have to do that. We're looking at, if you use our stock calculator, it's pretty simple. You can find it at millionairemob.com/stock calculator. You just input the number of shares you want to buy, the commission associated with the purchase, the commission, the buying price, then the selling commission, and then the selling price. So if I bought 10 shares of Apple, that's an investment of 1,700 bucks, not much. Um, and based on the quick and dirty valuation of Apple stock, I think we're at, call it a $200 sort of valuation. We're talking about 9% gain or $161 worth of profit, but that's assuming a 3% transaction cost. I use M1 Finance right now. That's completely commission free, completely free to use. It's 2019. There's no reason that we should be paying commissions anymore. So that's already takes you up 6% even more. And that's actually a gain of 15.8% or $273.80 of profit in your investment in Apple. So that's pretty straightforward, just quick and dirty between three different valuation methods to help you understand how to calculate your profit and gain. For me, 16% gain off of a potential stock in Apple. I think this is a core holding for anyone. Not a core holding, but it should be in everyone's portfolio, just given the sheer size of the business, the low payout ratio, likelihood of the dividend to increase in the future, as well as the avoidance of the dividend being cut or completely removed. So you should have some allocation to Apple. I don't think it's the most undervalued stock in the world, but then again, it's not overvalued at all, and so you should be able to sleep well at night owning Apple stock at the current valuation, just based off of this, quick and dirty. Um, but going forward, you should continue to stay invested, monitor the news of Apple, and let me know if you have any other questions regarding the valuation methods in the comments below.